Hey everybody, Smart Silver Stacker here. Hope you're doing well. The silver price is beginning to break out today. We've had a big move up almost $1, more than 4% on the day. And if we take a look at this weekly chart of silver from today's video sponsor, sdbullion.com, you can see what a big move up this really is. So they are sponsoring today's video. Make sure you check them out with the link down in the description. That's where I buy my gold and silver. And now let's talk about this breakout that we're seeing in the price of silver and if it's sustainable. So I want to take a look at what is driving this immediate action today, but also take a look at the long-term chart of silver, and we're going to examine whether or not we may be on the verge of a significant move up, a real breakout out of the pattern, kind of the holding pattern that we've been in for some years now. And also, I want to talk about what could catalyze a very big move up, because there are some developments in these markets today which indicate that very well could be right around the corner. So from Kitco News, we've got this headline: silver prices squeezed 4% higher after Chinese currency intervention. So according to Ole Hansen, the head of commodity trading at Saxo Bank, and I may be mispronouncing that individual's name, the current catalyst for this move in the price of silver is that the People's Bank of China intervened in currency markets last week, and that is triggering a short squeeze in the silver market. So is this the silver squeeze, the big one? I don't know about that, but we are seeing some action in the price of silver. And this is notable because we've been seeing some weakness in the sector over the past couple weeks, and it looks like that may be reversing. So it looks like the opportunities to pick up metal at a very low price may be behind us. We will see. Although I do consider the current valuation of silver still to be very inexpensive, especially when we take a look at this chart. Now, I'm not too into technical analysis, but this is from Clive Mond, and I think he does a pretty good job with the technical analysis on the metals market. And you can see here he has identified a cup and handle formation on this long-term silver chart. So this chart goes back to 2011, and you can see that he has got the cup and handle drawn out there, and right now we're in the handle, and there's this large bowl that the whole pattern is developing within. And, you know, if you're not familiar with the cup and handle pattern, this is a pretty common charting pattern that traders will look for a breakout in the price of any given asset. This is from Investopedia.com. And you can see what happens is you get this cup, then you get the handle where you have it, kind of a downward channel, which the price is moving in. Once you get a break above that trend line, you can expect the asset to move up significantly. And like I said, we've got one of those forming in the long-term chart of silver. And I really do think that we may be up against a catalyst which could drive the price to break out of this channel. And if that does happen, then this pattern will be confirmed. Now, if you look at the criteria listed on Investopedia.com, how high will the price of an asset go? It's determined by the difference between the bottom of the price of the asset in this pattern and the top of the handle formation here, or the breakout point. And the breakout point, you can see, would be around 25 bucks for the price of silver in order for it to break out of this handle, which is the thing that would confirm this pattern and probably lead to a significant breakout rally in the price of the metal. And so the difference there between 12 and 25 bucks, $13, you would expect, if silver breaks out here, that the price would run up to this price plus that difference. So 25 plus 13, you'd be looking at a breakout run to about $38. And that is a significant move up from where we are today. Now, I do want to point out that this chart was published on the 15th of August. So Clive Mond was calling for a breakout some time ago, and it looks like we may be in the beginning phases of this. Not some time ago, but, several days ago, kind of called this rally that we're witnessing right now from a technical perspective. The thing that I believe will drive this potential breakout in the price of silver going much higher, it's not going to be China easing. It may very well be the U.S. easing, though. We're in this environment, for years now. We've been seeing good news is kind of bad news for the price of the precious metals. When you get weak economic data It leads investors to believe that the Fed may ease sooner. If we get low inflation, that also can drive the price of metals higher when you get a weak inflation report, because it leads investors to believe that we may see the Fed reverse policy sooner. And that's been the trend for some time now. And so, when the Fed finally does actually acknowledge that they will need to begin cutting interest rates, possibly stimulating the economy via new quantitative easing, that is what will drive this breakout in the price of silver. And I don't think anything short of a Fed reversal in policy could lead to a rally, the type of which is forecast by this chart. But it is interesting that we are coming up against this resistance and at the top of this trend line right at the same time that the US economy is deteriorating to the extent that it may well drive the Fed to a reversal. So this is a story from July 27th. U.S. economy grows at faster pace than expected in Q2. We got those unexpectedly high GDP numbers in for the second quarter of 2023, and this was largely attributed to consumer spending, or a big chunk of it was attributed to a strong consumer spending season. And so that was leading to high GDP. And it is true that consumer demand is a massive contributor to GDP. If you take a look at this chart from the Fed, you can see that it makes up almost 2/3 of the GDP is driven by personal consumption expenditures. This is the shares of gross domestic product, personal consumption expenditures. And you can see that since the 1960s, 1970s, it's been on the rise, and it makes up a huge portion of US GDP. But I think it's safe to say at this point, based on some news that we're getting today, that the US consumer is finally getting just massively tapped out. And one of the indicators here is that we're seeing a huge decline in some of these consumer-focused stocks. Look at the chart of Foot Locker, for example. Down 33% today. Their earnings were disappointing. Earnings were released today. They showed dramatic weakness in consumer spending, in retail demand. A good chunk, almost half of Foot Locker's customer base is in the lower income bracket. And so this is showing that rising inflation and persistent inflation is really beginning to put a tremendous amount of pressure on U.S. consumers, particularly those in lower income brackets. Inflation is one of these things that kind of disproportionately affects the poor, because, if you're a millionaire, if you're making, hundreds of thousands of dollars a year, the cost of food, the cost of energy, the cost of clothing, the real basic necessities, those things, they make up a relatively small portion of your budget. And so inflation doesn't tend to really affect you. In fact, inflation dries up the price of assets that the rich may hold. And so, the increased cost of living really is a pittance to them compared to the appreciation that they see in their assets. But for the working poor, whose, monthly budget largely consists of necessities, there's not a lot of room for luxury goods or investing. Then when you see the price of basic necessities rising, it really puts a squeeze on them. And you're beginning to see this in the price of some of these stocks. And this is a chart. This is from Zero Hedge, a report that they had on this Foot Locker story. And you can see that the declines in price were not spread evenly. In Asia, they saw actually a slight increase in their spending. In Europe and the Middle East, it was a 2.3 decline. But here in North America, so basically here in the US largely, 12.4% decline in revenues. So that is indicative that the US consumer is beginning to get tapped out. I saw someone putting in the chat there, they went out to dinner and the cost was exorbitant. Yeah, it's crazy. Dinner last night, $80, 2 kids meal and 2 adult salads. Yeah, it's wild. I mean, I think we all know that inflation is significantly worse than the official CPI numbers would indicate. I mean, just go out to eat, just take a trip to the grocery store. Forget about, finding a place to live. If you don't own a home, or if you're just renting, or really even if you're in the market to buy a house, we know everything is just getting more and more expensive by the day. And it's only a matter of time before something breaks in terms of the US consumer and their ability to drive growth. And it's not just Foot Locker. Look at the chart for Macy's here. The 5-day chart down 17.28%. Another one of these consumer focused stocks. Someone says rambling rando in the chat. I guess. I mean, if you can't follow, can't pick up what I'm putting down here, then maybe it appears like I'm rambling. And of course, I mean, sometimes these live streams get a little bit rambling, but this is very pertinent to a potential breakout in the price of silver. Trust me, I'm getting there. I'm painting a picture for you here, folks. Peloton down 26.9%. Oh, not me, someone else. Yeah, there's always some rambling in the chat, no doubt about that. But I do appreciate all of you who join the live streams and who like these videos and who participate. And you, Nicholas McCabe, sorry, I thought you were calling me a rambling rando. Although, that label could probably be applied to me a lot of the time. So Peloton down 26%. When you can barely afford groceries, when you can barely afford going out to a restaurant, nobody's got the disposable income for a Peloton system these days, it seems. Let's look at the chart for Dick's Sporting Goods, the 5-day chart, down 24.7%. And it isn't just the decline in the consumer's ability to spend at these places, although that's a significant portion of it. A lot of it has to do with their inventory shrink, too. These crazy shoplifting trends that we're seeing go on. I mean, if you've been paying attention to social media, watching any of these videos, you've got police departments refusing to enforce laws, or it's not the police, I suppose, it's probably the local governments, but passing these crazy ordinances where, if you're stealing like less than $900 worth of stuff, they basically just let you walk out of the store. It's just a ticketable offense. I mean, people certainly, I think, are getting fed up with this, but this is a trend we're seeing. And it's not just that, the government is promoting this lawlessness. It is also the fact that consumers are being pressured by high inflation, and folks, I think, are just at the wit's end when you're trying to support your family or you're trying to just get by in this troubled economy, this centrally planned economy, and you can't afford things, you can't afford the things you need. People kind of take it into their own hands. So there's two sides to this, but the real driver of this increased theft and increased inventory shrink among these retail outlets, a lot of it has to do with theft. And it's all a sign of a weakening economy and consumers which are just being pushed to the limit. And it may be a sign that this credit card spending spree that consumers have been on may be coming to an end. I mean, this is the report. I've covered this recently, but it bears repeating. This is the Center for Microeconomic Data from the Federal Reserve Bank of New York. Their most recent report for Q2 showed that credit card balances hit a record $1 trillion, or over $1 trillion. Student debt, which is important to note here, is at $1.57 trillion. And I want to comment on those two things. So first of all, let's take a look at lendingtree.com here. And this shows us that the average rate of interest on a credit card in America today is 24.37%, the highest since LendingTree began tracking rates back in 2019. So think about that. We just hit $1 trillion in credit card debt, and that has an interest rate of 24.37%. So what does that come out to? I mean, on average, we're going to be paying, $240 billion in credit card interest. Can consumers afford that? Consumers can barely afford to go out and get groceries. So there is a limit to how much of this consumer spending that is driving GDP growth in the US can be financed by credit card borrowing. The rates are exorbitant. I mean, they're basically usurious. If you look at the what they call low interest credit cards here on LendingTree, look at that. I mean, that's very telling. Low interest credit cards, 13.84%, and the average, that's the low, that's the low end. So that's basically the lowest percentage that you can get on a credit card, 13.84%. The average, 18.4%. That is on low interest credit cards. Does 18.4% strike anybody as a low interest rate? I'm just curious. But rates have to be this high because I think the issuers of the credit cards, they understand that these debts are not getting paid back, at least the vast majority of them. So for the few folks who do end up paying them back, they've got to charge that kind of a rate to ensure against the risk that they are taking here, because it is a massive risk. These consumers are likely unable to pay these debts. I mean, maybe they can service them for a little bit, but when you've got $1 trillion in debt, you've got rising costs for consumers, rising inflation, persistent inflation, because remember, this inflation is cumulative, then you're coming to a situation where this is going to reach a head and we're going to see a big problem. He says that that credit card report also includes balances that are paid off at 0% every 30 days. Lix59 puts that. Well, that is a good point. And listen, if you're using a credit card, that is how I would advocate that you use it. I mean, I don't give financial advice on this channel, but if you're carrying a high interest credit card balance, probably stacking gold and silver is something you want to delay. You want to pay off that high interest credit card debt. And if you are using a credit card, and it is a good way to do it. I mean, there's some advantages there. You can get ones with no fees, and you can get ones that give you some cash back on every purchase. I mean, that's a smart way to use consumer credit. But if you're paying 18% on your low interest credit card, then you probably want to focus on paying that off before you do anything else. Because, I mean, yes, silver may appreciate significantly, or it may trade sideways for a while. It's always possible, but the credit card debt is a guaranteed loss, 18% on an annual basis. It's a huge, usurious rate of interest. And to your point, Lix59, it would be interesting if we could see a breakdown to how much of that gets rolled over, but I'm betting that the majority of it is not. I don't think that there's $1 trillion out there that's getting just paid off every month, and then consumers are racking that up. I imagine a lot of that is probably accruing a significant amount of interest, and the number keeps growing, and the interest rates are going up. So not a sustainable scenario for the U.S. economy. And, I mentioned the student loan debt, which is huge. Well, guess what's coming in October? This is the Office of the Attorney General of the District of Columbia. Don't forget that in October, student loan payments will be resuming. So any consumers who have student loan debt, which is quite a few of them, they haven't had to pay those student loans since 2020, since the payments were suspended, but those are coming back into effect. And so all of that money, those monthly payments, that money that the consumers would have had to spend on other things, now that's all going to vaporize, and that's going to have to go towards these student loan payments. And so this is going to put even more pressure on an already underwater consumer, a consumer who is already at their wits' end. And I mean, I understand there's a lot of inflation. It makes life difficult. You go to the grocery store and you spend, for a small family, $200, $300, $400 in a week. Easily, you go out to eat, it's $100, no problem. And you can look at a menu. I think Peter Schiff posted a McDonald's menu from the 1950s, and it was like a cheeseburger was a nickel, French fries a nickel, milkshake a dime. And it's incredible. And of course, if you're paying with a silver dime or a silver quarter, those things have maintained their purchasing power. But the dollar just hasn't, and it continues to lose a tremendous amount of purchasing power as we roll along here with these massive government deficits and this Fed debt monetization, which, is just on pause right now, folks. When we begin to see the economy truly crack, and I think that's coming, it's right around the corner. I mean, I showed you some of the stocks today, which are getting absolutely decimated in this environment of a weakening consumer. That is the big lifeline for this economy, as the consumer's been strong, but looks like that is just about exhausted. When the cracks begin to show, the Fed is going to slash interest rates. They're going to possibly resume debt monetization. They probably won't call it QE, but something like that will get launched if the collapse is bad enough. It all depends on what happens between now and the end of the year, but it certainly seems like things are aligning for a big decline in markets in general. Much weaker economy moving forward. Inflation is going to remain persistent. Interest rates are going to continue rising. And I believe it's going to force the Fed to intervene. And when that happens, we've seen all this news where the slightest hint of a Fed reversal or a Fed pivot will drive the price of the metals much higher, and like one day we'll see big moves. I mean, today we're seeing a 4% move in the silver price. And this party is just getting started. But you saw that chart I showed you, the cup and handle formation. That is definitely something to keep an eye on. If we get a breakout above this resistance on this chart, if we get a close, say above, I don't know what the exact number will be to break out of the trend line. I think we need a close around $26. We're not far off from that on today's rally. If this squeeze continues and we see a close above 25, above 26 bucks, there could be a strong likelihood we could break out of this cup and handle pattern and we could see silver heading to the $38 to $40 level before the end of the year. So even though we've had a big move up today, I do still think that silver is one of the most undervalued assets out there, and it looks like it may not remain that way for much longer. Let me know what you think in the comments down below. Thanks for watching, everybody. If you enjoyed this video, please do give it a big thumbs up. Don't forget to smash that like button. Comment and subscribe, share with your friends, and I do just want to say a huge thank you to all of you for tuning in. I will catch you next time. Stay safe, everybody. Happy stacking. Smart Silver Stacker